I hope this thing is, oh yeah, it is on, I can tell. Thank you very much. Thanks to the President, the Regents, all of you for coming today. It's a great honor to be here. My name is Derek Jeter. Or if you don't like that, Hideki Matsui. I'll be anything you want. Actually, this is a real challenge because here I am. I'm the economist, dismal, right? Oh, we're supposed to restore confidence, but I'm the dismal economist, and I have the additional challenge of having to be sandwiched between Pitts, Fitzgerald, Terrell, and of course our Velshi. This is going to be really tough, and so you just have to cut me some slack. Okay, so TICREF. Just to let you know, actually TICREF has, including St. Peter's College, has about 3.2 million participants around the country in nonprofit organizations, colleges, universities, hospitals, the Museum of Natural History, think tanks like the RAND Corporation. And we ourselves are nonprofit. The folks at St. Peter's who work there, as well as our other 3 million people, own us. And then the last little bit of advertising is that I just had to get this in because it isn't about me. It's about TICREF's advice and education. For the last several years, we've won national awards regularly for being the best advice and education provider in the country when it comes to financial matters. So with that over, it's a very complicated world out there, not just at St. Peter's College. But what we want to do today is talk a little bit about just what some of those complications are and what it means for not just investors, but for anybody who's trying to deal with the economic downturn and restore their own trust and confidence, much less anything else. So we'll start with that. What the heck does that have to do with our topic today? That's Pittsburgh in 1979. Okay? That's Pittsburgh today. So Pittsburgh has been transformed. And it's not, this is not a talk about Pittsburgh, but I think there's some analogy here. Pittsburgh faced enormous challenges in the 1970s and 80s. It was a one-industry town. 10% of the workforce worked directly in the steel industry, and almost 50% of the population depended in some way on the steel industry, directly or indirectly. Steel was under pressure. It was no longer viable the way it was organized. It was becoming international. It was globalizing. And all of that entailed. And it was a pretty dirty town. Today, Pittsburgh has a lower population, but higher education levels, higher incomes, clean air, and it's a knowledge-based community. Pitt, Carnegie Mellon, the healthcare establishment there are the drivers of economic growth these days. It's an amazing transformation. They faced enormous structural changes and managed to do well. Not so well that Pittsburgh is regularly voted one of the most livable cities in the United States, and it has now begun to gather international recognition. It was no accident that the G20 met in Pittsburgh a few weeks ago. It was because of that transformation that the meeting was attracted there. What has that got to do with what we're facing? Well, we're not a one-industry town or a one-industry nation, but we are facing significant structural challenges in this country and around the globe, and they also have to do with globalization. Globalization of financial services, the rise of giant mega elephants, some of whom are close by, and even in this room, HSBC, Bank of America, great things, but also pose challenges. The rise of new financial instruments, credit derivative swaps, asset-backed securities over the last several years. The rise of a huge pool of global savings having to do with the savings rates overseas as compared to the United States, and that ability of the global savings to flow across national boundaries, and the ability to produce goods and services in many, many places in the world. So we'll see what some of the implications of that are as we go along. This is the test part of the presentation. An unlabeled curve with dots. Actually, the unlabeled curve is the S&P 500 from peak to trough and then back up to more recent. The first, of course, elementary lesson is that when you have a 50% drop and a 50% rise, you're not back where you started. And that's what this one shows, right? That's 55% down in the S&P from peak to trough, October of 07 through March 9th of 2009, and then another 50% more, and more than 50% back up since then. The dots are just interesting things along the way, and I won't you can, the test is, I'll tell you some labels and you can figure out where they go. The collapse of Bear Stearns, the collapse of Lehman Brothers, Fed lowering interest rates to 0, the establishment of the TARP and the TALF and the PPIP. You have to remember all those. And the appearance of green shoots and leaves. That's a Washington term. The patent folks will know that. And the better economic, and also the passage of the $790 billion fiscal stimulus package. And the beginnings of some better economic outlooks, such as instead of 6% on an annual basis, 6% down in the GDP in the fourth quarter of 2008, and another 6% in the first quarter of this year, and another 1% down or a little less in the second quarter, we're now seeing a 3.5% increase in the third quarter. At least that's the most recent estimate. Okay, that's your, you can, now we look forward, except we look forward to a beautiful view of the southwestern United States. I should have had them do the shot from right out here. It's so marvelous. We're going to talk about 10 things, and I'll give you 4 other things to look for the future. We'll just run through this quickly. GDP. One of the things that I want to do with all of these things is begin to get you to think, as we all know we should, get away from CNBC think, which is what's happening. You know, we already had that bashing a little earlier, so you took the wind right out of my sails when it came to Jim Cramer. But to get your attention focused, get it away from what's happening this 2 minutes and in a space about that narrow to broadening out both horizontally and temporally. And you'll see what I mean by that, because you see here a couple of some spaghetti at the bottom. That's GDP growth for developed countries, US, Europe, the UK. If I put Japan up there, it'd be a little lower than that because it's kind of been in the doldrums for a couple of decades. And you see China at the top, and if I put India, it would be kind of there too. And the couple lessons, one is that the potential GDP growth rate, potential economic growth rates in developed countries aren't very high. It's about 3%. The base is so big because they make up such a high percentage of world's economies that their potential growth rates just aren't that high. But what you can see is that they're pretty highly correlated, and you can see the downturn over there on the right. And that's pretty severe. We thought we had a downturn in 2001, but it barely shows up. The other point is China and India and Brazil and some other countries. Much higher potential growth rates, much more volatility in their economies, but also the ability to recover quickly. And China certainly has, and India is in the process of recovering quickly. And a couple of implications for the long run. U.S. is was about 50% of the global economy in 1945. It's now about 20. China, was not even on the radar in 1945. China and India are growing rapidly. They grow. They have a long-term high growth rate. They recover quickly. Their economies are going to be a much bigger portion of the world economy as we go forward. We all know that, but this is a wonderful illustration, and it has major implications for public policy and your own investment outlook. Interest rates. Well, it actually isn't interest rates. These are credit spreads, the difference between a credit instrument and a treasury yield. But the point is, you can see the blowout in the end of 2008 and the recovery, the really remarkable recovery in the credit markets, completely froze up, as we all know. And that's the indicator there, because it took an enormous amount of interest or yield to get anybody to buy anything that had to do with the credit in that period. And you can see that although the recovery isn't complete, these are numbers for the top number is emerging market bonds, the middle number is junk bonds, and the bottom number is highly rated AAA corporate bonds in the U.S. So then there's inflation. Remember, I'm trying to get us all to think more broadly and also for the long term. So I've thrown up here 85 years worth of inflation. Well, rather, 74 years worth of inflation and 11 years worth of deflation. And that's why I did it, because we actually see that blip over there on the right, going down. That's the first time we've had serious deflation this year, in other words, since the late 40s, and the first time, and the real deflation was in the 20s and the early 30s in this country. People actually don't, a lot of them people don't remember that deflation was rampant in the late 20s as the agriculture sector was going down the tubes even before the rest of the economy. Why do I even mention this? Inflation's been about 3% on average over this period. It's because economists care a lot about deflation. It scares them a lot. Inflation scares people too, but the problem with deflation is you guys stop spending. If a car is going to cost less in 2 months, you're not going to buy one today, or at least if you think so. And that can take on a self-fulfilling prophecy, which it did in the 30s, it did in Japan in the 80s and 90s, and they didn't want to. That's one of the major reasons behind the stimulus and the actions that the Fed took. Job losses. Okay. 7 million jobs lost since January of 2008. And in fact, if I ran, it starts in January 2008, goes till recently. These are the incremental job losses in the gold bars, the cumulative job losses in the dark bars, and dark part of the bars. And before January 2008, these bars would all be pointing up. There'd be net job gains. The latest number came out this morning, 190,000 jobs lost last month, and 10.2% unemployment rate, and 17.5% underemployment rate right now in the United States. That means people who took jobs, underemployment, who took jobs, but they're not working as much as they want to, essentially. So people talk about a jobless recovery. All recoveries are jobless. Don't let them fool you. The unemployment is a lagging indicator. So it means that all recoveries start out to be jobless because employers don't want to hire until they know they're going to sell a lot of stuff. The real issue is how long will it be jobless? And this one could, depending on public policy and some other things, be jobless for quite some time. There's a big debate out there about whether, was the stimulus enough, just right, too much? And if you think it was too much or just right, there'll be no more stimulus, and we'll have a very slow recovery, or at least that's a bet that a lot of folks are making right now. Savings rates. Okay, pat yourselves on the back. This thing says, this series says you've all begun to save. Over here on the right, see the bar, the jagged line is going up. Savings rates are now in the 5 to 7% range. That's wonderful, except it's terrible for the economy in the short run because consumption in the U.S. economy is 70% of the total of GDP. So now it's about 65%, and there's a big hole. And in fact, that's one of the reasons the government stepped in, because it's the only other big entity out there that could even begin to make up for the fact that we're all now saving and not consuming. Now, in the long run, it's a great thing, obviously. What we saw since 1980 is the savings rates coming down from 10% of household income down to 0 in this decade. Several reasons for it. One, declining interest rates. You don't get as much on savings, but probably more important, availability of consumer credit. How many, for those of us who have the same hair I do, how many credit cards could you get in 1980 versus about a year and a half ago? I mean, you sort of get infinite credit cards a year and a half ago, right? So availability of consumer credit. The other one is people feel like they saved when the market goes up. This is very well documented. You go around and ask people, well, did you save anything? Oh, yeah, I did. My, my mutual funds just skyrocketed, so I have lots more savings. Well, no. Out of your income. Are you kidding? I don't save anything out of my income, but I feel like I saved a lot more. That's the phenomenon that's going on here, too. And so the question is this a permanent effect on the right-hand side or a temporary effect where we're saving more? In the short run, we should save less. In the long run, we should save more, or rather, somebody needs to make up for our lack of our increased savings in the short run. But it's a good thing to save more in the long run because then you have the ability to invest. Housing. Two indicators crammed together here. The jagged line is and the scale on the left is housing starts, peaking out at 1.8 million per year and troughing at 380,000 per year. Those are the most extreme numbers in both cases that were ever recorded on this time series that was started in the 1950s. The smoother line and the scale on the right is the rate of change in housing prices as measured by one Robert Shiller and his colleague Case, which referred to a little earlier. Now, this is 20 metropolitan areas in the United States. And you can see it bottoms out in 2009, but it's still negative. Housing prices are still dropping. In Phoenix, it's down 50% and still going. Until these things become much more positive, I don't think we have true economic recovery. Commercial real estate. Now, it's different from, this is office buildings, multifamily residential, rentals in other words, retail and industrial properties. And you can see that the total return number, which is the blue thing, was wildly positive through the 90s and most of this decade. Long-term expected returns in real estate are about 8%, maybe 9%. I'm not saying that's what they'll get every year, but that's the kind of long-term expectation that we have. And you can see that it was up at 15 and 20% at various points. And so we are experiencing the first downturn since the late 80s in commercial real estate, but there's always a cycle in real estate. And it's, of course, driven by the value of buildings. The two components here are the appreciation value of buildings, and the flatter line is the income. Income has gone down, but not to the same extent. This downturn is severe, not as severe as the one in the late 80s and early 90s. We don't have as many see-through buildings. Some, but not as many. Commodities. Well, this isn't actually all commodities. This is West Texas Intermediate crude, which we all remember peaks out at 146 bucks in July of a year ago, July, and then drops down to the $20 range and now is about 80 bucks. It's very volatile, as is gold, as are all commodities. You don't get an income from owning a commodity unless you do it through a company that manages commodities. But you see kind of a long-term trend up here. And that may be something that characterizes the future as developing countries recover and begin to demand a wide range of commodities for purposes of development. Just to remind you, the ninth out of 10 here, the bad news in the markets last year and the good news in the markets this year. So we all remember that. I won't dwell on it, but the S&P down 37% last year and up about 20% as of September 30th this year. And that's the 20% up is on top of another 25% down between January 1st and March 9th. So in other words, if you're Jim Cramer, you took all of your money out of the market in October of 2007 and put all of your money back in the market on March 9th of this year. I hope he did it. It's fun. It's fun to do that. The fixed income picture is a little more interesting in the sense of if you look at the U.S. aggregate, which is the Barclays U.S. aggregate, it used to be called the Lehman Brothers U.S. aggregate. The aggregate is up 5% last year and up nearly 6% this year. And you say, oh, okay, fixed income, good, 5% each year, that's great. But then let's look at what the components of it. Treasuries last year up 12.4% basically. Everybody wanted to own Treasury. Remember those credit spreads I showed you? They all wanted to own Treasuries. Nobody wanted to own credit instruments. We all know that. We live in New York and New Jersey. Down this year, 1.21%. Just a remarkable turnaround. Nobody wants to own Treasuries. On the other hand, U.S. credit, which is corporate bonds, negative returns last year. Nobody wanted to own them. Yields high. This year, up almost 15%. Are we having a bubble? Everybody wants to own these credit instruments. You look at U.S. TIPS, inflation bonds. They are unlike any other treasury. These lost money last year, and now they're having a remarkable rally this year, up 9.5%. People were worried about deflation last year. Now they're worried about inflation. I think perhaps not with complete confidence. They should, I would be less confident, let's say, that they should be worried about inflation. Now I've got 4 additional things I think we should all really be paying attention to. One is the value of the dollar. This is a trade-weighted index of the dollar. It's not just the dollar versus the euro. It's the dollar versus a bunch of currencies weighted by the amount of trade we do with those countries. Comes down from about 107 in 2002 to about 78 in 2008, bounces back up when everybody wanted to own U.S. treasuries and other U.S. investments, so they all bought dollars in order to invest in the United States. Now everybody's selling dollars to invest overseas, and the trend continues back down. The U.S. government says it wants a strong dollar. It is acting as though it's willing to let the dollar continue to drop, and which it has been. But I think this is rather than worrying about the burning buck this week, I think that the more important thing to think about is over the long run, what is the dollar going to do and what does it mean? I think the long run, the dollar is still going to trend down for a couple of reasons. One is other countries are developing rapidly. Another one is U.S. government isn't propping the thing up. The third one is what better way to pay back our national debt than to let the value of the dollar fall, right? And you can do that through inflation, but I don't think there's any inflation. We dug too big a hole in our economy and there are wage issues that I'll show you in a minute, and there's just no impetus for inflation out there. So I think that the adjustment mechanism is the U.S. dollar, and I'd say that's a long-term indicator to keep track of. Here's another one. You don't usually see this from dismal economists, but it's pretty dismal. This is the real change in earnings and wages for people in the United States cut by education level. It's the best we can do to get to skill levels. And this is between 2000 and 2008, which were mostly good years. And in good years, people's income generally rises in real terms, not in this decade. Down, you see the employment share, and then over on the right, you see decreases across the board with one exception. People with MBAs, JDs, sorry, Patton, and MDs. And I think it's not MDs, because I think MDs have been getting squeezed this decade. It's just we couldn't break them out. It's the folks who are on Wall Street, corporate America, have done well. Most others have not. Now, there's no interest in condemning anybody here. The point here is more of a macro, long-term point. You can't run an economy this way. If you want people to save, if you want to control credit, so it's constructive, in a macro sense, you want people's incomes to be able to go up. And so I think that's one of those big structural issues. Remember, we were talking about big structural challenges. That's one of them. How do you get people to buy into the U.S. dream, and how do you give them the actuality of the U.S. dream? And I think it's a big structural challenge that we have to face. Another one is bubbles. Now remember, I sort of said I didn't think there was much. The outlook was not for inflation. I really don't. We've dug a big hole in the economy. We have that 10.2% unemployment rate. Our wage, earnings have declined rather than increased. There's just not, and the global changes in manufacturing, in capital flows, there's just not a lot of ability for anyone to dictate prices across the board. What does happen, though, with a big pool of global savings is I think you get bubbles. And we've had some. We've had some very severe ones in the last 10 years. There's been bubbles forever, at least since the Dutch discovered tulip bulbs. But in the more recent years, we've had severe bubbles with severe consequences when they burst. The dot-com revolution, housing, equities more recently. Are we having more bubbles now in emerging market stocks, perhaps, or even corporate bonds? Not sure. I don't know. I'll let Bob Schiller figure that out. But you can't read this, but what I'll tell you is what we did was just look at how long are bear markets, how long are recessions, what is the change in the stock market during a bear market or a run-up. And what this will show you is that we had over 55% decrease in the stock market from peak to trough in the last bursting of the equity bubble. Before that, it was a 46% drop in the first part of this decade. And except for except for 73, 74, those are the most extreme numbers since the Great Depression. I haven't even put up the real estate bubble bursting, which is in the residential area. This is the biggest burst of a housing bubble that there's been in at least decades, maybe since we've begun recording it. So I'm suggesting that what may be characterizing our current circumstances is the potential for further bubbles. I don't know where they're going to pop up. I don't know, I don't know what their pathway is going to be, but I think it's something in a broad sense with these other macro challenges. I think that's what to look out for. So what do? How do we restore trust and confidence in light of all of this? I think that there's some simple things, and it goes right back to what I was suggesting a little earlier, and that is taking the attention away from what's happening this 2 minutes and within a very narrow band of, probably just stocks. It's very easy for all of our entire focus to just narrow right down on the thing that's the most volatile or the thing that's bothering us the most. TICREF participants, last year we measured it, lost an average of 18% of their, we don't have 401ks, we have 403bs and 401as and all, but it's the equivalent. It's a defined contribution plan. They lost about 18% on average. Some lost more, some lost less. But remember, the stock market went down 37% last year. TICREF participants are well diversified. 2/3 of them, for example, have something we call TIA traditional, which is an account that is guaranteed to provide at least 3% return every year. It's an insurance company thing, but it's a diversifier and represents a foundation. And it ain't stocks. It's boring, because it provides 3% plus every year. And, we have stuff like bonds and asset-backed securities and real estate and timberland. It's boring. It's not fun to go to a cocktail party and say, hey, my TICREF went up 4% last year, or my TI traditional did. But it does what it's supposed to do. And the point here is it doesn't matter whether you're in TICREF or not. It's that if you're thinking about a broadly diversified portfolio, if you're thinking about getting good advice from these good companies around here that have been mentioned, including ours, getting great advice, which you can get from these companies, to help you think of much more broadly about your investment plans and investment horizon and so forth. And then you think long term and forget about whether the market is going down 37%. Because you've thought about a diversified portfolio, you've thought about rebalancing, you've thought about connecting your investment plan to a set of long-term goals instead of what you heard at the last cocktail party, then you're going to get through this. And you're going to have more confidence when things are bad, not just when times are good. So it ain't, after the fall, lots of puns, but we think that things are improving. We think that the recession is over. And in fact, we ought to be tied into this. We're not. But the folks who actually decide on whether there's a recession is a committee of the National Bureau of Economic Research, which are all academics. One of our trustees actually sits on it, Jim Perturba. He won't tell us. But we think the next time they meet, they're going to say the recession was over in June or July or August or something. Doesn't matter. What matters is things are improving. They will improve, but if you stop thinking about what's happening this month and start thinking about what's happening over the next 5 years or the next 20 years, and not just with stocks, but with a wide range of assets, that's what's going to restore your own trust and confidence as an investor. And you can memorize that. That's the disclaimer. Anyway, I want to thank you very much for your time.
Thank you so very much. You can tell by the dead silence that people were really interested in hanging on your every word. And we do have some questions.
Sure.
How about the reliability? Can we depend on the figures from China or India or Brazil? Or is there a little smoke and mirrors there?
Well, it's interesting, of course. The numbers you can't rely on as much because they don't have, the U.S. and developed countries have terrific organizations, the Bureau of Economic Analysis, for example, at the U.S. Treasury, that keeps track of all this stuff in the United States. Not as good in other countries. I think there's two worries. They cook the books and just simply accuracy. Sure, there's a problem of accuracy, and there's sometimes some book cooking. Less and less on the second part as time goes on, because it's just not in the interest of China. If you cook the books 1 year, then you got to cook them again and again and again, and people figure it out and stop believing it. So I think there's much more interest in accuracy in these countries. There's not as much of an ability to be accurate, but nevertheless, I think even if you're saying, okay, the Chinese GDP growth rate, for example, is not necessarily 10%, maybe it's 9.5%, that's still terrific. And I think that TI-CREF has put his money where its mouth is. We have this fund called the CREF stock account. TI-CREF invented the variable annuity in 1952. And so this account was around as the only stock variable annuity that TI-CREF had, and it's about $80 billion now. Over the years, we've increased the commitment to foreign stocks. We actually had a board member, I love dropping these names. We had a board member who said you should do two things. One is index, that's in the 1970s. Another company got all the credit for indexing, but we did it at the same time. And the second thing was buy foreign stocks. So we have now 30% commitment to foreign stocks in the CREF stock account. And of that, about 4% is emerging markets. And we'll keep increasing that over time because we believe in the long-term story about developing countries. Oh, the person's name was Paul Samuelson, by the way, on our board.
I don't know whether that's making your clients nervous or calm. But in any case, there's a little different slant. How will the developed economies worldwide, especially the U.S., survive the cost of the aging baby boomer population?
Wow. I was hoping to avoid that one. No, it's a significant, obviously significant problem. Japan is already hitting it. Italy's hitting it. These are because of their age structures. China, I mean, it's not a developed country, but China is digging itself a huge hole because of the one-child policy, right? They have a lot of they have generations of men running around now, and China is rapidly going to become an aging society because of the huge decline in their birth rates. Okay, so this is it's a huge problem, not just in the United States, but elsewhere. How are they going to solve it? Well, they'll limp through it. There's going to be tax increases over time. They'll probably figure out some ways to trim benefits for some cohorts. I'm not saying I know how and when and why and exactly how much, but there are enough issues out there that it will be, that the only way we're going to be able to solve it is by doing some cutting and trimming. The real issue right now is healthcare costs. It isn't necessarily so much Social Security, although Social Security is an issue in this country. But I think that when you look at what goes on in public policy, the attempt will be to trim and stuff and do things around the edges until they get it right, and hopefully it will muddle through. U.S.
is not a one-industry country, as you pointed out in some of the slides, but this questioner suggests it's a no-industry nation. What's the solution for the next generation?
Well, it's not that we're no industry. We certainly have some, we still compete extremely well in knowledge-based stuff. And in certain places, I think our auto industry is not one of them at the moment. But we do have strong manufacturing. It's just a small percentage of GDP. We have very strong industries in many areas: healthcare, high tech, et cetera. But what we've gotten away from, and we could never sustain, is the ability to be monopolists in many industries, or at least completely dominant. We can't do that anymore. Many industries are now just dispersed around the world. And so it's not that we have no industry, it's just we have to compete. And I think that the way to do that is to, well, I'm preaching to the converted at St. Peter's College, but I really believe it, and that is we've got to emphasize education in this country all the way from preschool all the way up to graduate school education. And it is not clear that we have as deep a commitment to the education system as some other countries. However, we still have a head start in many areas. I think that's a key to the future. It is also the willingness to experiment with new industries and new technologies. There's a lot of talk about green technologies and about nanotechnologies and so forth. Let 100 flowers bloom. And it may be that some of those things will prosper in partnership with government. Don't know, but that has been the way some other industries have developed, and this may need to happen here too.
Do you think, given the slowness of what's happening, that we need another dose of incentive, stimulus, TARP, XYZ, whatever?
Yeah, on May 4th, the New York Times had 2 columnists on its column page. Usually there's 4, and there are only 2. Each one got a half a page. One of them was the usual suspect, Paul Krugman. And of course, what he was saying was it's not enough. We're in danger of not a long extended U, but maybe the swimming pool where we fall into the deep end and we have an awful hard time getting to the shallow end. The other one was Alan Meltzer, who was a distinguished economist for Carnegie Mellon, and Meltzer was fretting about about inflation because of all of the stimulus, monetary and fiscal stimulus, and mainly that the Fed wouldn't begin to raise interest rates in time to prevent inflation. And these 2 views and variations are really dominating the thinking right now. And there's a lot of worry on both sides. Will we create too much inflation too quickly, or have we failed to stimulate enough? My own sense is that $790 billion sounds like a lot of money, but given the $14 trillion size of the U.S. economy and the huge hole that we dug by being way below that 3% potential economic growth, we could use more stimulus in the next year or so. The issue, though, is that we're now getting statements saying, "Oh, the stimulus is basically over." You know, it's not. Most of that money is going to get spent next year. The tax cuts and initial spending by giving support to the states, to bail out California and its teachers, for example, that's happened, right? And that's going to go away. What's not going to go away is the ramp up to infrastructure spending, the ramp up to research and development and healthcare spending, because those things take proposals and vetting and all that stuff. That stuff's going to happen next year. So it's going to be a different kind of stimulus. And so the question is, if you do get to a point where it looks like we need some more, it may be that what you need is another jolt to the states and the quick spending stuff, rather than and let the longer term stuff on research and development and so forth, let it continue to unfold. So I think that it's less a matter of, do we need another 790 billion, but maybe we need a concentrated dose in certain sectors.
Maybe this is on a more personal note, but given the bond bubble and the low money market interest rates, where should the non-stock portion of a portfolio be invested? And secondly, how long do you think it will take for the CREF clients with 401ks to recover?
Well,
I think they're related questions.
They're related questions. Where do you put your money now? Well, I don't say that. It's actually, that's a subtle question, because if you look at bonds, interest rates have been coming down since 1980. We know that, right? And they're as low as they've ever been. They're certainly literally as low as they've ever been on the short end. And they're quite low on the long end too, 3 to 4% in long bonds, at least in treasuries. So what do you do now? Well, it seems to me that if you're just chasing returns, you're not going to go buy bonds. If you're looking for a diversified portfolio, you're not just going to buy stocks and you're not just going to buy bonds, but you're also going to think about, are there other places to go? And I think that alternatives that are available to individual investors are reasonable things to do, but not instead of those traditional asset classes, but certainly as supplements. So I threw up commercial real estate. Commercial real estate is going through the doldrums, or worse right now, but it will recover, and there'll be those sort of expected long-term 8-9% returns coming back. That's a reasonable alternative. I mentioned for TI CREF participants, I certainly would include that as well as TI traditional. And these are for diversification, not just chase and return purposes. Stocks, even though the question wasn't about stocks, stocks will continue to do okay. I'm not saying in the next 6 months we may have sort of, we may have exhausted ourselves for a little while, but for the long term, and that's where TI CREF participants will recover in their 401ks. Now, what does recover though mean? I guess recover means the high water mark, right? When the Dow was 14,000 and everybody's portfolios were there.
I'd take that.
Okay, good. So see, this is a psychological, we reset. This is one of those reset things that people do. Oh yeah, when the Dow was 14,000, that's the number I have to get back to because that's the minimum I need, right? Except that on the day the Dow hit 14,000, everybody was going, yeah, I never had that much money in my life. But now all of a sudden this becomes the minimum amount that could possibly sustain us. And I'm not making fun. I do this too. So the question is, yes, we all want to get back to the equivalent of the 14,000. It's going to take some time. But yes, TICREF participants lost an average of 18% last year. They have recovered significantly this year. So maybe the losses I haven't made the measurements, but let's say they're in the 5, 6, 7% range this year. So it isn't as extreme as one might think. I have no date when I talk about recovery, but what I do want to point out is this notion about sort of resets and thinking long term and not worrying too much about it. I'm going to take my dad, who was a TICREF participant, still is, and is retired. My mother made him maximize his contributions to TICREF, and he never thought about it because he thought in international relations and didn't understand investments. And lo and behold, he retired after decades and seemed to have enough money to live on. This is a very difficult thing to do, is to sort of not think about what's happening today, but think about what do I do over the next 5, 10, 15 years.
And finally, a different slant again. Do you feel that the government's expanded involvement with private industry, free markets, regulations, is creating a business and personal culture of dependency?
Okay, we take it, creating a culture of dependency in the business area. I say no. I think what's happened in some of the structural changes that's happened. I'm thinking about back to the Pittsburgh analogy. One of the structural changes is, well, here's another way of putting it. The financial markets and economies evolve, and yes, they get affected by public policy and so forth, but there is a natural evolution, and they always evolve in ways that public policy doesn't anticipate. That's happened time and time again. The problem is that the oversight system, in public policy, et cetera, tends to get locked in and doesn't change very much for long periods of time. So the two tend to grow apart. And then there comes a time when because of a crisis or whatever, there's a debate that starts about, well, what do we need to do to bring the two back into better alignment? And I think we're in one of those periods right now. Certainly there was one that went on in the 30s that produced, let's say, the Glass-Steagall Act. And then in a bipartisan move, we got rid of the Glass-Steagall Act. So what do we need to do now to cope with some of these fundamental structural changes that I mentioned, like the big mega institutions, like the capital flows, like new instruments? And there are proposals going on right now, but I don't think it's in the sense, I don't see it in the sense of creating dependency, but rather a debate about the two, oversight and the system itself kind of grew apart. What do we do to bring them back together? Do we force the financial system to go back to where the oversight system is? Do we take the oversight system and say, okay, we're going to adapt it to where the financial system is? Or do we figure out what are the big risks in the system, the systemic risks that we need to cope with, and deal with those, and then begin to let the financial system evolve into the future as it should? I think that's the debate that's going on right now.
And I think that leaves us on a note worthy of much pondering, maybe making the right decision, and certainly thanking Mr. Hammond for his remarks.
Thank you.